Good afternoon, everyone. If you're on the East Coast or Central Time, if you're on the West Coast, good morning, good late morning. My name is David Scherer. I'm co-founder, co-CEO at Origin Investments. I'm super excited to have Robert Dietz back. He came last June and did an amazing job. Robert has worked at the National Association of Home Builders for the last 20 years. The last 10 years, he's been the chief economist at the National Association of Home Builders. And he just shared with me that you travel literally every week, which means he's not only research oriented, but he's seeing on the ground what's going on throughout the country. Last week, he was in Greensboro, North Carolina. He's heading to Asheville. Super excited about this webinar. I think that there's a lot going on, obviously, internationally, but even domestically, we have a lot to talk about the secular influences of AI and what that could potentially do for job participation rates and ultimately housing. That's what we're here to talk about. We're going to get into all of these different areas. The title of this is Affordability, AI, and the Future of Multifamily. You will hit all of these. The format is going to be probably about 10 minutes of slides that Robert's going to go over. That'll be sort of foundational to the conversation that then he and I have. We'll go a little bit deeper and maybe it'll answer some of the questions. Thank you. That we have about 600 live guests watching, so thank you for your time. If you have questions, just keep sending them in. I think our conversation, Robert and I's, will probably be about 20 minutes. And then we'll try to answer probably 20, 25 minutes of live questions. So with that, do you want to plug the Ohio State University, or can we get started?
Yeah, absolutely. I spent 6 years at Ohio State. I know we probably got a fair number of Big Ten folks here, so that can be either good news or bad news for my credibility here. But it's great to join you again, David. I'm flying to Chicago tomorrow to speak to builders in that market, and like you said, we're going to go through some kind of introductory slides. Let me just kind of give you the high level take I've heard from particularly single family builders here in 2026, which is, oh no, not again. And what they're referring to is 2025 was kind of a disappointing year, a year where they expected to see some gains, and then interest rates remain higher than expected. 2026 has got kind of that same feel where headline risk, the Iran war, concerns about future inflation, obviously the energy shock, has frozen a lot of buyers into place. We have a kind of sluggish labor market. And all of that, of course, is having some complicated effects on the rental market, both the single family rental market and the multifamily market. So as David indicated, I've got some intro slides, really kind of thinking about scene setting and thinking about setting the tables. We kind of talk about some of these other topics in detail, but I thought I would just kind of lead with affordability conditions. Now, there's two things to keep in mind. We're looking at the 10-year Treasury rate, of course, and the 30-year fixed rate mortgage. We've seen a bit of a rise in the 30-year fixed rate mortgage. Right now, it's around 6.3, 6.4% on the Freddie Mac series. We expected this was a year that we were going to see a glide path closer to 6. And of course, in the last couple of weeks, it's ticked up. A lot of that is due to volatility in the 10-year Treasury, demand for Treasuries. And we have gotten a little bit of help, at least in terms of thinking about Fannie and Freddie, that the administration announced that Fannie and Freddie were going to hold on their balance sheet an additional $200 billion of mortgage-backed securities. But that has not offset the rise in the 10-year that's occurred in terms of the post-Iran war period. So what we can say, and it's difficult to forecast in this environment, but rates are going to stay above 6%. That's going to act as an affordability headwind. And then the second factor, which I don't think gets discussed enough, is the price to income ratio, which is not on this slide, but right now it's close to 5-to-1. Historically, for home buyers, it was 3-to-1. And that 5-to-1 ratio means the down payment requirement, particularly for prospective first-time buyers, is a lot more challenging. So you've got a lot of buyers, they're frozen in place, they're going to remain in the rental market here in 2026. So a tougher environment for the for sale market, some additional cyclical strength for the rental market. The other factor is what we were talking about in terms of buyers and renters and how that composition could shift is how many households are actually forming. And what we've noticed over the last 2 decades is a rising share of what we can call a failure to launch. So you're looking at a graph of 25 to 34-year-olds, the share of them that live with their parents. And you can see back in the year 2000, it was close to 12% of these that age cohort that lived on their parents' couch with their parent as effectively an involuntary landlord. Well, over the period of the prior decade leading up into COVID, that share continued to rise. And in fact, right now, roughly 1 out of 5 25 to 34-year-olds lives on their parents' couch. And so it's not just a composition shift in terms of for sale and for rent, but we have this delayed number of households. Now, the negative view of that is that these households have not been unlocked, and therefore they're harming real-time rental demand. The more positive take, and I'm not sure how much I particularly lean in on this, is these are potential households that could be unlocked with favorable labor market conditions and some improvement in both rental and for sale housing affordability. I'm a little more skeptical. I think of these as households that are kind of on the sidelines and probably going to remain there. So that's an important part of the current housing demand story. So you take in financing costs, construction costs, which we can talk about during our conversation in terms of maybe the labor shortage, building material issues, energy pricing for developers. This reflects right now our multifamily starts forecast. Now, if you look at the table, you can see there the total for 2025 and a growth rate of 17%. There's some controversy about this. This is the census data that we use. Our bigger multifamily builders said they saw a decline in construction activity in 2025. What we think is happening here, and because of that decline, there's a general feeling the census data is wrong. But what we think is happening here is a geographic split. We saw declines in multifamily permits in the urban cores and higher density markets in 2025, but we actually saw growth in multifamily construction in the exurbs and outer suburbs, and even if you think of rural areas along highways. And this is mostly garden style, low rise multifamily. Do I think it was up 17% like the census data says? No. Do I think there was a gain in 2025? Yes. So that kind of puts me a little bit of outside the consensus view of the historical data. But putting that to the side, our expectation is relatively flat conditions. We've got a bit of a decline, but that's kind of a reflection of some of that controversy over the 2025 level. But relatively flat levels of production for multifamily going forward, for this market leveling off at around 380 to 390,000 units starting construction each year. And keep in mind, 95% of that is built for rent. Historically, multifamily was 80% built for rent. So the built for rent share within multifamily has gone up. And we can talk about single family built for rent as part of our conversation. As I said at the beginning, there's a number of macro headwinds that are holding back buyers, causing declines in consumer confidence. And I think the big one, which is not reflected at the end of this slide because we just got the data point, but the new inflation measure reflecting the rise in energy costs from the Iran war, the CPI level of inflation went from 2.4%, which is the last data entry on the slide, and it jumped up above 3%. What does that mean? One, it's having an impact on consumer confidence. Consumer confidence by the University of Michigan study, for example, is the lowest it's been in decades. If you look at the internals, by the way, there's a heavy political element, but nonetheless, consumer confidence has gone down. And it does mean that we have to curb our expectations for the Federal Reserve this year. In fact, the Treasury Secretary, and I even saw Kevin Hassett from the White House economics staff today talking about the fact that they understand that the Fed is going to need additional clarity in order to resume reducing the federal funds rate this year. So I think the expectation is the Fed is going to be effectively on hold. And of course, there were some market investors talking about even a need to raise rates. I don't think that'll happen. I think the policymakers are kind of going all in on productivity growth as ultimately enabling additional Fed rate cuts despite this uptick in inflation. And of course, productivity growth is something we can talk about as part of our conversation in terms of AI and how that's going to affect the labor market and how that's going to affect the real estate industry. So inflation is going to tick up. I think most policymakers are going to look through it. The long run trends are declines, provided we get that productivity growth moving forward. And then lastly, we did some long-term surveying of our members. Now, keep in mind, NAHB builder members include single-family builder members, they're custom builders, regional production builders, and the national builders. We have a large number of remodelers, and we can talk about remodeling rehab. I think that is something that is really going to change the real estate industry going forward. And then we also have multifamily builder members. And what we ask them to do is take a look out over the next decade. And what are those factors you think are going to have a negative impact on your business and those that will have a positive impact? And you can see on this slide the top items listed as items to basically be worried about. Government debt levels, which of course can be responsible for pushing up long-term interest rates, including the 10-year Treasury and the 30-year fixed-rate mortgage. The declining fertility rate, that is a big issue, particularly if you're thinking about the mid-2030s. We do a long-term forecast that we can talk about, but we're expecting single-family construction to likely peak in the early 2030s and then begin to decline because of that declining fertility rate and the impact that it's had over the last 15 years. Just the generational groups that are coming behind the millennials are smaller. The third negative element, the long-term inflation outlook, which will, of course, capitalize in terms of long-term interest rates. So some of those are connected to policy. Some of those are connected to demographics that we really can't influence a lot. But those are the items giving builders heartburn in the survey that we took at the start of the year. And then if we turn the other side, some items that offer some opportunities and abilities for the industry to grow, the number one item was the aging housing stock. And I think this is going to have significant impacts on single family, multifamily, and remodeling in terms of rehab spending, tear down construction, which is going to be a rising trend in the single family sector, the ability to add density into markets, combining tear down with zoning reform that allow to build townhouse construction, for example. But that aging housing stock, I think, is going to be both a market item and an item that policymakers are going to have to deal with because, of course, aging homes are less energy efficient, less resilient, and those are all items policymakers want to have an effect on. They tend to focus on new construction, but they need to focus more on that their stock. That's the low-hanging fruit. A second item for positive impact, work from home. That changes the geography of where people live. And any time we get a change in the geography of both jobs and where people live, it is beneficial for demand for new construction of residential housing. And then the third one is something we can talk about again today, AI. And I'm sort of interested to see that showed up on the positive list because there's a lot of doomsaying about AI and its impact on labor markets. But I think builders took the perspective that there's a lot of disruption opportunity, productivity growth, enhancing activity that AI can add to the sector. It's not perfect. In fact, I view it as labor augmenting rather than labor replacing. It's going to change how office work occurs, for example. But builders reported that as something positive. And again, the big thing there is productivity growth will be higher. And we know that when productivity growth is higher, wage growth occurs. And with higher wages, you get increased demand for housing. And I'll just mention the fourth one, modular and panelized construction. We could spend a few minutes talking about that, but there's some technologies in terms of how we build that could benefit the real estate sector as well. So with that, I'll turn it back over to David, and we can maybe talk about some of those items in detail.
All right, thank you, Robert. And there's a much longer deck that we'll share with everyone as a follow-up. So I look forward to receiving that. Let's jump right in. I really am interested in your answer or perspective on the affordability differential between renting and owning. And I was able to read your whole deck, so there's quite a few slides on that. But let's take a deeper dive there, because I guess my first question is, where is it, and where is it year over year? What caused it, and what does that mean looking forward? Do you think it's going to endure, and why? And what does that mean for rental housing versus home ownership?
Yeah, I mean, you can look at a variety of different rental affordability measures. We do one called the Cost of Housing Index that looks at the share of an ordinary household's income that's required to build either a newly built home or a typical resale home. And right now, it's about 38% of income at a national level. Now, it's going to be higher than that, of course, in expensive markets like coastal markets, certainly in California. But in almost all of those markets, it's cheaper right now to rent than it is to buy. And the sort of the technical limitation of some of those kind of rent-own decisions is they're often comparing the monthly payment, right, principal, interest, insurance, taxes, compared to rent. But they're not including that other big challenge that most housing economists would say is really the binding constraint for those new buyers that I mentioned earlier, which is the ability to get the liquid savings necessary to make the down payment. So, on a kind of a pure own versus rent decision, I've seen numbers ranging from 40 to 60% more expensive to buy than to rent, particularly given some of the increased supply in rental housing that we've had from late 24 into 2025. But there's certainly a lot of frustrated home buyers, despite the fact that for sale inventory has increased, because the affordability conditions still don't match out for their budgets. So what do we think is going to happen? Well, I got to say, I'm probably a little bit more negative than some of my peers in the housing economics community. I don't see a lot of big changes in that kind of calculation between affordability conditions for rent and for buying. So we have a very kind of muted set of increases, for example, in single family construction, for sale housing activity. And we think multifamily rental and single family rental is going to continue to be supported by those frustrated buyers remaining in the rental market for longer periods of time.
And what caused this? I mean, let's talk about that for a second, because one of the things that really interests me is this is a new thing. This idea of it's so much more expensive to own than rent. That wasn't true 20 years ago, 10 years ago, even 6, 7 years ago. Isn't this a sort of COVID, post-COVID thing? And to me, we're in the middle of a social experiment, and we actually don't know the outcome. Here's the experiment. What if you took housing that's been parity for 40 years to rent to own, I mean, plus or minus 5%, and you moved it to 40 to 60%? What's going to happen in 5 years, 7 years, 8 years, 10 years? And then throw into that equation just differences. You were mentioning the declining birth rate, but people are getting married later. People are forming households later. All this is to me pointing to a population that's going to rent longer. I mean, that's the only place I go.
I think that's right. So let's take the first part, which is how did we get here? I would say COVID revealed and accelerated the impacts that were built into the real estate market coming out of the Great Recession itself. So if you kind of think about the years 2003, 2004, up through 2007, were kind of the boom years. We overbuilt, particularly single family for sale. There was an inventory glut that existed from late 08 until roughly 2010, 2011. And then from 2012 up through COVID, we underbuilt single family housing. Now, the reasons for that are very complex. It was a skilled labor shortage, lot availability was challenging. I think a big issue was that bank lending to those smaller single family builders that build about 60% of the housing, that was really risk averse. The flows dropped by 50, 60%. So the available capital wasn't there. And the result was a housing deficit. And there are different estimates of how big that deficit is. My team thinks the housing deficit right now is about 1.2 million. You've probably seen in the media discussions of 4 million, 5 million. I think those numbers are too big, but nonetheless, a housing deficit measured in the millions is fairly significant. So the impact, okay, basic supply and demand. We didn't build enough housing, so the price to income ratio went down, which means prices for sale housing were rising faster than incomes, particularly for that buyer demographic that was smaller. So the demographic effects, you listed a couple of them, I totally agree. Declining marriage rates, declining fertility rates. You can see this across the industrialized world, by the way, and it's particularly prevalent in countries that experience the same effect in the U.S., which was an under construction of single-family housing. So all of that means it's going to have demographic ripples that are going to come into play no later than the mid-2030s. And in the meantime, you've got a lot of frustrated buyers who, as I said at the beginning of my walkthrough, are either living with their parents up through their mid-30s, or they're staying in the rental market for a longer period of time. And the impact of that has been to increase demand for rental housing, particularly in what we called a few years ago the superstar cities, but places with outsized population growth and job growth. And then the emergence, at least in construction, of a thriving and growing single-family for rent or single-family built for rent sector, which has gone from roughly 3% of single-family housing starts to roughly today about 12% of single-family starts are being built for rental purposes. And that represents a little bit of competition for apartments, but I also kind of use it as a bit of a compliment in the sense that it's facilitating households to stay in the rental sector a little bit longer with varying kinds of structure types as their demographics or pet needs, or the kinds of things that they would look for after renting in a multifamily building and moving to a single family renting. So the market provides and the market adjusts. The market is the best way to allocate capital, but the impacts of that lack of building of for sale single family housing has had impacts, and the big one though is budget constraints. The lack of those younger households to be able to buy now is going to have a big wealth effect down the road. We'll have to deal with that. Now, I like the way you phrase it, which is it's a social experiment. The vice president has talked about this a lot in terms of thinking about what's this failure to launch in terms of younger households. And our argument from a policy point of view to policymakers is bend the cost curve, allow us to build more single family and multifamily housing, and we will unlock some of these currently pent up households from being able to form.
Interrelated to this, Robert, I have a 5-year. I did a 5-year in 2021 on a home in Lincoln Park, Chicago. I pinned the low in rates, and I think J.P. Morgan was doing a special at the time. And anyway, I locked in at 1.68% on a 5-year, and it expires this year. It expires in November this year. I'm also selling the home this year. And my rate obviously would go from 1.68 to 6 at that point. Yeah. Do you know the weighted average duration of mortgages? Because there's this presumption that everyone's running around on a 30-year. That's not true. I was on a 5. There's 10s, 7s. They're all over the map. But right now, a lot of the supply is frozen with people like myself who are sitting on 1.7 money that won't sell. Why would I sell? I'm borrowing at 1.7. But that's going to change, right? And so is that part of the experiment, if you will, is when,
yeah.
Because the cost of home ownership for a lot of people is not being felt yet, but it's about to be, right? At some point.
That's right. There's kind of a slow unlocking as the share of households that have mortgage interest rates below, say, 4%. Declines, and that just occurs through the aging of those notes and the natural cyclicality in the sector. But yeah, I was just looking at some of the data. Right now, I think 50% of outstanding mortgages have a 4% rate or lower. And that share has been going down over time. It is responsible for the lock-in effect, and we have seen real big declines in mobility. That's a business opportunity, I think, for rental investors, because it does mean if you have a housing demand in front of you, they're a little bit less likely to move than they were, say, 10 years ago. But over time, some of that will be unlocked. And the key to kind of getting the real estate engine going again is moving those frustrated first-time buyers back into the system. Uh, the big thing, I think, on the for sale side, though, is the idea that they're not going to have to wait around for a 5 or 4% mortgage because, one, we don't have that forecasted. We think rates are going to kind of remain in the 6% range. What we think is going to be the fuel for that engine is a slow accumulation in savings that's going to allow them to accumulate a down payment. But it's going to take some time. So the idea that was suddenly, we'll get a 5.9 30-year fixed rate mortgage and we're going to get big swings in rental demand and for sale demand, we don't think that's going to happen. We think it's going to be a slow process. And as you said, people take out different kinds of mortgages that allows them to deal with their time in the pattern. But the big impact is the fact that household mobility has come down, and that's helped single family rental, for example, because there are people looking for those larger residential structures that are going to remain in for a longer period of time during a period of time where they can't afford to purchase a home.
Yeah, I'm going to move us to the next point, point of conversation. But what I see is that multifamily, which is what we do at Origin, obviously, it's corrected meaningfully as an asset class. Multifamily today is worth less than it was in 22 as a building. If you bought a building in 22, it's worth less today, almost uniformly. There might be a couple exceptions here or there, and it's not materially less, but it's less. And in terms of cash flow, it's been difficult because the cap rates versus 10-year note yield spreads, it's just not great. And it's been really de-risked. I mean, in the sense that multiples on earnings in 21, 22 were 28 to 30. Now they're 18 to 20. That's what happens when you go from a 3.5 cap to a 5.25 cap. It's just math. I don't feel like the for sale housing market's been de-risked. I mean, I look at that market and I go, well, geez. I mean, I'll give you an example. I'm moving to Miami for part of the year, and I had a decision to make. I could buy or I could rent. And I looked at both, and I wound up renting for two reasons. One, actually more, but I'll focus on two. I'll maybe more, three. One is flexibility. I'm not sure if I'm going to like Miami. I'm not sure where I want to live in Miami. So why would I want to buy? Flexibility. Understand when you buy a home, you're down 6 to 7% day one. Taxes, title, transaction costs, brokerage. Yeah. And you can amortize that across the long hold, but not 2 years. It doesn't work. Yeah. You got to commit. I'm not willing to commit. The other reason is it's just a lot cheaper. Back to our math. Here it's a little bit less. I'm going to rent. I could buy a lifetime unit and all of the HOA. It's condo, the HOA, the down payment, my opportunity cost of capital on the down payment. I'm plugging in at 8%. I think it probably could be more, but I'm using that as a plug. Remember, if you're buying a home, there's an opportunity cost of that capital. It should be making money somewhere else, right? You got to put that in the equation. And then, of course, your financing costs and your insurance. And long story short, I'm renting for about 35 to 40% less per month or on an annualized basis than I would if I bought. So that's just a rational decision. The third reason is, and this is sticker shock, but I've seen it. If you buy, it's really likely you're going to furnish. And then you go out and you buy furniture, and I promise you the depreciation on furniture is 95% as soon as it walks in your door. Like if you get a brand new dining room table with chairs, my partner Michael actually had this happen. He told me about it. He didn't like the chairs. He tried to take them back. He got basically 8 cents on the dollar for a brand new chair, right? I don't want to do that. They have nice furniture in the condo. I'm just going to move in. I move my clothes. I'm done. So I'm living this in real time. I'm making these rational choices. To me, there's a downside to renting though too, and I'll acknowledge it. When you rent, you don't have certainty of housing. I'm renting for a year. That doesn't mean I can rent for 6 or 10 or 20. And so as a family, if you have young kids, that idea of nesting is real, right? I mean, that's a real thing. We're humans, we're emotional. Like I get it. And I've been there. I've raised a family, right? All right. So I'm going to move us on to, you mentioned when you were talking about housing, you were mentioning build for rent. And you
Yes.
touched on this briefly, but I think we had a decent amount of questions in this area. One, there's obviously various versions of new law coming through the House and Senate, which you should talk about briefly.
Yes.
I'm always a little reluctant to talk about these because they're changing and we don't really know what's going to be the final version, but you can speak to that. And
Yes.
the other is just, rental housing when it's done in this way. We call it build for rent, but it's, in my mind, because we're very involved in this space too. We develop it, we own it, we operate it, we lend to it. This is just horizontal housing. Vertical. Think of a tower, a condo tower, or a rental tower. This is similar amounts of units, but it's horizontal. You need large pieces of land, and ideally, you're finding them in areas that also have, most likely drivable retail, but you don't want it in the middle of nowhere. No one wants to live in the middle of nowhere. So that's kind of the intersect there. But why don't you talk a little bit about that? I personally don't. I get a lot of questions about, is this competing with what you do? And the answer is no, we do both. I mean, I'm perfectly happy doing that or a wrap deal or a garden deal for that matter.
Yeah, absolutely, and that's what we hear from our apartment developer members, that this is a separate real estate item. It's serving a distinct part of the space. When we try to measure the size of it, it's like I said before, it's about 12% the single family starts. It's about 100,000 units a year. That is a big gain from historically. It was kind of smaller. It was about 3% of single family built for rent in terms of the total single family starts universe. And that 3% was mostly concentrated in seniors housing. So these were downsizing retirees in retirement type locations. The emergence over the last 10 to 15 years of single family built for rent as a distinct construction sector, as an asset class, has really occurred, and it's geographically lumpy. You can find it concentrated in markets like Atlanta. I saw some of that when I was in Atlanta a few weeks ago, markets like Phoenix. And it's really kind of interesting. It's not just targeted to seniors. It is targeted to younger mobile households that expect to be in a market maybe for 2 or 3 years for work and move. There's people who look for it in terms of lifestyle decisions. And I don't know in terms of your portfolio, but it seems to be disproportionately townhouse type construction that kind of fits into that horizontal multifamily. So it functions a lot like multifamily development. Now, getting to the policy, the fact that it functions a lot like multifamily housing is part of the unfairness of this rule that's been stuck into the pending 21st century road to housing legislation that was meant to be a supply side driven provision to get out government red tape and burdens and just reducing the efficiencies of adding that housing supply. As it moved through Congress, and of course we all know how this happens, something that our lobbyists at NAHB referred to as a poison pill was added in by a senator from Massachusetts. You can maybe guess which one. That basically said for single family built for rent construction, it has to be sold within 7 years to a family, to a household. And the question is, how do you break up, a single plat of land that's developed as horizontal multifamily? This is a really, kind of disastrous type item to add to this bill. All right, well, here's the good news. The House passed the bill without this provision. The Senate passed the bill with it. And right now, the momentum in DC is to try to force a conference committee. This is the old school way of developing legislation. In recent years, you'd get something passed by the second chamber, and then it would send it to the other chamber and force it to take it as is. It doesn't look like they're doing that. And during a conference committee, there's a broad recognition among Democrats and Republicans and liberals and conservatives and anybody that wants to increase housing supply that this single family built for rent prohibition of institutional investors, those holding more than 300 units, would have to sell single-family built-for-rent housing is a bad idea. So I can't put percentages on it, but I think if they are successful in a conference committee, of course, that has to progress, that provision will be diluted or moved out, because we have explained to them, the Urban Institute has explained to them, this is going to reduce housing supply. My estimate is it would probably reduce single-family built-for-rent construction by 40,000 units a year. The Urban Institute's economists have said 80,000 units a year would be eliminated by this.
So Robert, I'll tell you, you mentioned Atlanta. We have an opportunity zone site. It's an old GM plant. It's large. It's 40 acres. It's just south of downtown, very well located, becoming very much infill. And typically when you have a site that size, phase one is a lower density phase, which in this case is townhomes. We're going to build a couple hundred townhomes. And then as the site gets activated, you add maybe a wrap deal or something more dense. And that's phase two. So what you're talking about in real time, and this is the key point, if it was just a 7-year hold, I'm fine. I have no problem. I don't want to hold it more than 7. My investors don't want me to hold it more than 7. We're going to build it. But the issue of you have to sell it to individual owners. Okay, well, here's the problem with that. Number one, now you have to replat everything. It's one site, but more importantly, that changes your tax consideration. If I exit as a condo for sale unit, that's a very different tax consideration for an investor than as a multifamily. You move from cap gains to ordinary income, and I'm waiting. We have a site that's completely economically viable. It's it's a 6.8 cap. I mean, it's an amazing investment for our investors. It's also a huge asset to the home, the person that wants to live. I shouldn't say homeowner, but the person that needs housing. This is an area where people are paying $500,000-$600,000 for a townhome, and they're going to get the equivalent experience for down 25-30%. Right? So like they're winning, my investor's winning. It's viable. It's going to create jobs. So, that's the key point to me. Isn't even the 7 years. It's this individual. What is that?
Yeah. And that's the political thrust of it. I think, like a lot of bad legislation, somebody had maybe back in the day a kind of a good intent, but hasn't thought through all the steps. That is now the debate that's taking place. And it's been interesting to watch people say, oh, I didn't think about that. This is why conference committees exist. And I'll just tell you from our organization, we're actually opposed to the bill with this provision in it. This is a bill that we think is the most important housing supply legislation in 2 decades. That's how important we think this particular provision is as a poison pill.
Yeah. All right, I got to move us along because we got to get back in schedule. So I really wanted to talk to you about AI and its effects because most of our questions really came into that area. So I'm going to just ask a broad question and answer it however you want. But AI, in my opinion, will create opportunities and disruption. I don't know the sequence. It'll be both. I don't know which happens faster or doesn't. But just take the broad question and relate it to housing. Like, how does it eventually make its way through into the for sale housing and the rental housing market? And in particular, Robert, the demand function, because I know that we're undersupplied. I don't have to debate that. That's 100% true. And we're going to be more undersupplied in 27, 28, 29, 30. That's just math. The starts didn't happen that should have started. I don't know what demand will be in the future. Neither do you. But I'd love to hear your thoughts on how AI, because it's an X factor. I mean, absent that, I would feel much more confident in my perspective.
Yeah, I think, every sector, every industry can have kind of a similar discussion. What's the impact of AI going to be? It is going to be disruptive. I think it is a little overhyped. I've used it for coding. I've used it for doing searches. I think like most people, it kind of gets you 90% the way there for a job that could be automated. It does replace a certain level of entry-level employment. So let's think about it from the supply side and the demand side. Supply side first. So when we've asked builders, how much are you using AI for your businesses? Definitely larger builders are using it more. They're using it for coding. They're using it like other sectors are. But the dominant thing that builders are using AI right now for is marketing purposes. And we actually find for smaller private builders, only about 20% really are using it at any kind of measurable scale. So there is a market here that is ready to take advantage of this. We certainly know that construction as an industry has lacked productivity growth. It's had roughly a fifth to a third the productivity growth that the overall economy has had over the last 30 years. So this is a way that we can help reduce costs, which will then allow for producing more of that attainable supply by bending the cost curve in the right direction. Now, on the demand side, you can certainly find the kind of the doom version of AI. We saw that a few weeks ago with that article that kind of made its way into everyone's hands. That even affected stock pricing before the Iran war. But I kind of take the traditional economics view, which is AI is a positive productivity shock, which means that in the short and medium run, it can raise structural unemployment as you get kind of the transition effect. But generally speaking, positive productivity shocks are good for the economy. They don't result in long-term big increases in unemployment. But more importantly, higher productivity growth means higher wage growth. Higher wage growth allows the Federal Reserve to be more dovish. I think this, by the way, is a big part of how incoming Fed Chair Kevin Warsh has sort of sold himself to a president that wants a dovish Fed, which is the idea of productivity growth is going to enable eventually, not this year, but eventually some additional rate cuts. But overall productivity growth should raise wages. And I'll take you back to what we were talking about earlier, the price to income ratio for home buyers. That would be improved by faster income growth. It would help rental demand. It would even increase second home demand, which is one way that the real estate market can expand. So I view AI as labor augmenting. I think it's going to improve the overall productivity of the workforce. I do think it will lead to some rise in structural unemployment, particularly among office workers. We sort of internally kind of thought that it might replace over the next 4 or 5 years 20 to 25% of office employment. That will be something that will have to be digested by the labor market. And then we're hearing, and on the supply side, we're hearing from builders and trade schools and the like that there are a lot of high school students that maybe would have considered going to college and getting a degree that wasn't particularly useful, and they're starting to think about, in growing numbers, trade opportunities. And that's exactly what the country needs in terms of manufacturing and construction and the service sector. So that's a little bit more of the positive take on AI. I'm kind of going to double down on it because that's been the economic history. And in the longer slide deck that you mentioned earlier, I've got a slide that looks at the labor force for the U.S. economy going back to 1850. If you look back in 1850, 80% of the workforce in the U.S. were farmers. Today, it's 3%. And you can see these dramatic changes in terms of industry composition by employment, but the market is great at adapting, and it creates new jobs as older jobs fall by the wayside with productivity gains. So this is a positive shock. I recognize that it's difficult to advise somebody going into college or high school today what to study, but we think it's going to be good for productivity growth, good for income growth, and then ultimately good for real estate activity over the next decade.
Yeah, I agree with you. One of the things we're doing in our own, we have our own AI that we use for rent predictive. It's just a decision-making tool. It's called Multilytics. But what we've done with it is we've now added an element where we're segmenting job sectors and then imposing that into the regions and into the cities, because it's our belief that sectors like healthcare and teaching are going to do quite well, but we believe there's going to be disruption in both coding, tech, office. And so you really are probably going to want to invest more in areas that are going to be less disrupted in the next 3 to 5 years. And that's how we're approaching it. So if you're an investor, it might be something that you think about, not just the unemployment rate, like, hey, is it going from 4 4.2 to 4.8, but also the sectors that are going to be most affected, because certain areas of the country are pretty weighted in those areas. Okay, so last question, then we'll go to Q&A.
Yep.
What is an interesting area in housing that you'd like to talk about that I haven't covered?
Yeah, I kind of hinted at it in my walkthrough. I think the thing that people aren't talking enough about, that there's not enough stories in the Wall Street Journal on, is the aging housing stock and what that means for rehab, tear down construction, redevelopment. I think last year when I spoke to you in June, I talked about the rising trend of townhouse construction and urban development or urban village development on old shopping mall locations. That trend has continued. The remodeling sector, the rehab sector, improvement spending, and we're not just talking single family housing here, we're talking about older multifamily. We think all of that over the next decade is going to grow by about 30%, just based on the age of the housing stock and the need to reinvest. So there's going to be great opportunities for both new construction and redevelopment, tear down construction, which for single family, by the way, tear down construction starts are 7% of single family home building. A decade ago, it was 3. We think it's going to be above 10. And infill development. So that kind of redevelopment of the existing stock, you're thinking about real estate in favorable commuting locations in the inner suburbs where you've got housing stock that was built in the 30s, 40s, and 50s, is really going to be an opportunity. The trick, though, is this is often undertaken at a kind of a neighborhood by neighborhood level location, more often with smaller builders than big builders. So you're going to have to do your homework, get guidance going, get the kind of the research, because it's not going to be like master plan communities and tracking bigger builders. That frankly is easier to do your homework in terms of where the growth opportunities. But that's the trend that we see over the next decade, particularly as household formations slow. The impact is going to be on rehab and redevelopment.
We're going to jump right into Q&A. I'll take the first, and then you can just pick one while I'm answering it, and we'll just alternate. First question, we'll go back to AI. Is the use of AI in investment decision making a competitive advantage? If so, how? I can only speak to us at Origin. So I mentioned Multilytics. That's our growth rate. Our growth rate is the growth rate of rents. And we've been working on this for 6 years. It takes in billions of pieces of data each month and makes an unbiased decision at the address level. So it's quite granular. It's not even the zip code level, it's the address level. And it makes a 5-year prediction on rents, including starting rents. And it's been quite accurate. It's a very powerful tool that we use. The other is called Multiflow. Multiflow, essentially, just think about it as an agent that's being trained on Origin's own data. So we've underwritten hundreds and hundreds of deals each year. We've been around 18 years. And all of those memos, think of 5,000 20-page memos that's feeding the knowledge. And then it also leverages the general knowledge of AI, of the Anthropics of the world, et cetera. It's trained to make a decision on the deal, and it's very powerful because our funnel, before it gets to an investment committee, the deal officer has to submit the memo to AI, our AI, and that AI asks questions. It grades out the deal. It informs our investment committee about what it thinks. It doesn't make the decision, but it helps us to have the most robust conversation we can. And as all AI, it gets better and better every day because it gets more and more information. The other thing we're doing at Origin that's a little bit more global, we hired an external firm to build our own AI, not meaning our own, we bring in, it uses whatever model exists and we get all the upgrades. But think about AI, when you use AI, if you download a memo, you're getting something back, but you're giving up information to AI. That's going into the public sphere. Not with ours, not the way we built it. We have a moat around Origin and our data. All the data leaves encrypted, but we can leverage all of AI. And so we're creating agents for everything. We have marketing agents, we have accounting agents, we have underwriting agents, and you can build your own agent within the system. So I think we've adopted faster than most companies. And I would actually, I would tell you, my partner, Michael, he's the true champion of this. He's on it 2 to 3 hours a day. He's making sure the 70 people at Origin, you can't use AI at Origin if it's not ours. You're not allowed to. You use our AI because it's encrypted and everything you do informs it, right? So it takes that type of champion if you want to produce change at a company. You can build a nice tool, but who's making sure everyone uses it, right? And I could go on and on. It's very important for us, but I actually believe that every firm will have to make a decision. Do you want to participate in this or do you want to fall behind? That's what I believe. So I'm done.
Yeah.
Next question.
Yeah, agree. There was a great question I saw that said, can you talk briefly about how modular and panelized technology can be positive for home builders? Is it purely cost driven? I always want people to kind of walk away from one of my talks to take away a number that they find surprising and will remember. I'll try to give you one here in terms of modular and panelized. First, some definitions. Modular construction, that's 3D construction. You're building most of the structure off-site in a factory. Panelized is 2D construction. You're building in terms of panels and you assemble at the work site. Then there's manufactured housing. That's mobile homes. That's about 100,000 units a year. By the way, the Road to Housing Act that we talked about earlier would probably increase the volume of manufactured housing. But modular and panelized, those first two, they represent only about 3% of single-family home building right now. In the late 90s, they were 7 to 8% of single-family home building. So this is a technology that gets talked about a lot, but the truth of the matter is its market share has gone down. And I'm not arguing against it, but it's typically, and this applies to multifamily construction and single-family construction, it is typically overpromised and underdelivered. Real estate construction is not something like building TVs or cars that you can capture those economies of scale greatly. Every site is different. It's got different building codes, zoning requirements, all the different factors that make it difficult. And so the result is that modular and panelized construction share has actually gone down. I do think because of the lack of productivity growth, it is going to go up. AI, ironically, could be one of the reasons that can help in terms of improving the speed of design and approval processes. But we don't think it's going to make a huge difference in the market. The market will still remain undersupplied. But that market share of about 3% has some room to grow, and it could go up to 7 to 8%. And that can be one of the ways that the market will help us build additional housing. So right now it's pretty small. It will grow in the future.
Yeah, I'll give you an example of some true innovation that I've seen, and it's scalable. This is actually somebody that used to work at Origin in our AI, but he started a company, it's VC backed now, and their company uses AI and satellite to measure everything. Whether if you want to repave a parking lot, you used to hire a person and they would go measure it. They can do it more accurately, faster, and at 1/20th the cost, right? And so they're growing quite rapidly, and there's a lot of applications here. You can do it on roofing, lots of things, right? So this is literally someone that I think the world of. He worked here, 5 or 6 years. I wish him the best. I hope he listens to this at some point, because he's one of the most intelligent people I've ever met, and he's super hardworking. He works 12, 15-hour days every day, and he's after something, and he's providing value, and it could change things. So, but I agree with what you just said. Like in terms of modular, we were looking into modular as a way to cut costs 12 years ago in development, and it didn't really make sense, actually. Like it didn't, and it hasn't changed that much. 3D printing, that was the big, my partner and I invested in that company. I forget the name, but it's out of Austin, Texas, because we wanted to be at the cutting edge if this was going to do something. They're not doing 3D printing of homes to scale. I mean, what's the percentage of that? I invested in that 8 years ago, right?
Well, less than 1%. It's a few thousand units a year. Yeah, it's very small.
Yeah. I want people to understand that innovation in housing, it's kind of glacial.
Yeah.
I mean, it just takes forever, right? I might not be working anymore by the time some of this stuff starts getting up. And people have a hard time with it. I mean, I spoke to a group, a YPO group in West Florida. I think it was in Naples a couple of years ago. And one of the members was saying, look, basically his thesis was all housing, rental or built housing is completely overpriced because the innovations in housing are going to create the new batch that's going to be down 60%. And, that's his perspective, and he believed it. And I didn't really, I told him what I just told you, but like, I didn't want to get in an argument. I just said, okay, like I respect your opinion. I just don't have any data that can point that this is happening, right? Anyway, I'm going to move on. Here's a really good question, and I'm going to be brief because I want you to talk. It was about actually you can answer this, and I'll answer it too, but take a crack. How do you provide low-cost housing and yet still profit as an investor? Do you want to try to answer that, or should I?
Yeah, I'll give you the answer in terms of my travels, which is you need to identify a location that has, kind of a pro-development political environment where you've got permitting offices willing to move quickly, zoning works. That's where I see the most success. So it's the Greenville, South Carolinas, and the Greensboro, North Carolinas, not necessarily those locations in California.
Yeah, and I totally agree with you about all of that. But then I would only add, you need to find municipalities that support the equity structure itself. And they do that with either forgiveness of real estate taxes. We did 3 deals in Colorado Springs because we pay 35% of the, I think another way of saying is we get 65% off our real estate bill for 10 to 15 years. The net present value of that provides equity, if you will, to the deal, right? Because lenders treat it as equity. Other ways are TIF or tax credits are another way to do it.
Loan amounts of tax credits
versus equity. But the big answer to this question is there's a required return on equity, whether you're building low cost or high cost construction, and it has to be viable to the investor. So you can't build $300,000 a door stuff and rent it at $1,000 a month. It doesn't work. The only way that works is if somehow, some way, I'm getting free equity. It can be in all the forms I just talked about, but absent that, it won't work.
Yeah, totally.
We have time for one more, so scroll through and then I'll
Yeah, I saw another good one that came in as we were talking, and there was a longer question. It basically said that the country is changing ethnically and culturally. We've got different demographic groups that have different birth rates and different demand. And that is something I skipped over that I think is worth looking at, which is when you're examining market by market, are you looking at a market where you've got more immigrants that are more likely to form a multi-generational household? What does that mean for structure type? What does it mean for renting? Does it mean that, if you're looking at a single family rental, is it going to be a household that will have what we used to call a mother-in-law suite, but a kind of an internal apartment to that unit? We're seeing rises in those trends. So multi-generational housing right now is about 3% of households. We expect that share to go up as we move forward. So it's going to change the type of units you want to invest in and the type of units that are being built.
Yeah. Robert, I want to have you back again soon.
Yeah.
I told you this in June last year. You're the most impressive person I've interviewed. I think you're fantastic. And you told me earlier you want to potentially leverage your PhD into being a professor. I think you'll do very well there too.
Yeah, and obviously it's because I stand in front of builders and investors and they tell me when I'm wrong. So I of course correct.
Well, but you step out and you have an opinion, and that's really all we can do. My email is there. We didn't answer a lot of the questions. We had probably 20 we didn't answer. I just want to be respectful of people's time too. If you have a question that you want answered that wasn't, email me. I will answer it, or our team will answer it. I see your emails there too, Robert. I don't want to volunteer that unless you want emails. If you do, great. If not,
it'd be fine.
Yeah. But thank you for your time and safe travels. And I thank you for your time, everyone who listened in. And let's have a good week. Apparently, the Iran war is about to end, so that would be very helpful.
Thank you, David.
Right?